let's get straight into today's tactical macro briefing. We're breaking down the overnight global market moves and handing you the exact technical setups you need for today's trading session. If you're a market participant looking for a clear map of where things are headed right now, you are in exactly the right place.
So what's the overarching mood out there? Well, markets basically spent last week doing what they absolutely do best, changing their minds. We got that weaker than expected U.S. jobs report, which effectively threw a bucket of cold water on those Fed rate hike fears. And with that out of the way, investors could finally stop sweating the geopolitical headlines and go right back to obsessing over economic data points. It's setting up this incredibly fascinating dynamic. We've got softer U.S. data across the board, cooling job growth, easing inflation, but it is completely clashing with some seriously resilient markets. Think about it. Bad news for jobs literally fueled a massive relief rally for equities. We saw equities rotating, lower bond yields stepping in to give everyone a little breathing room, and all of this happening despite that ongoing volatility in the AI and semiconductor space. Now, you can really see the ripple effects across the major assets. Take oil, for example. With shipping through the Strait of Hormuz kind of normalizing, oil cooled right back down to pre-conflict levels. And hey, that's great news for countries like India, giving them some much-needed room to maybe trim fuel subsidies. Meanwhile, that soft U.S. data dragged the dollar down to a 3-month low, which gave the euro, sterling, and yen a nice little lift. Oh, and gold? Yeah, it's glittering all over again as falling rate expectations revive its shine. Behind the scenes of these asset moves, the central banks are definitely flipping the script. You've got the Fed's Kevin Warsh stepping away from that rigid forward guidance we're so used to, and the ECB is right there echoing the exact same flexibility. There's even some political and legal intrigue swirling around Fed Governor Lisa Cook right now. The bottom line? Central banks are finally swapping out their crystal balls for actual flexibility, which makes a lot of sense since, let's be honest, forecasting hasn't exactly been their strongest hobby lately. All right, let's head into the technical war room for currency setups and catalysts. Starting off with the DXY, we're looking at a classic buy-on-dip setup here, resting right on a crucial 100.47 support pivot. Resistance is looming up at 100.90 and 101.41. Your catalyst for today? Keep a close eye on the US S&P Services and ISM PMI data. Then we have the euro, which is trading pretty flat against the dollar, but actually idling at a one-year low against the pound. Watch out for German factory orders and the slate of ECB speakers today. Key support for EUR/USD is sitting at 1.1388, with resistance stacked at 1.1447 and 1.1483. Flipping over to cable, the pound found a pretty hard rejection at the 1.3368 pivot, but if we get a solid close above that level, it totally opens up a buy-on-dips theme. Remember, UK 10-year gilt yields are staying elevated, and they're pricing in a 75% probability of a rate hike this year. Plus, you've got Bank of England Governor Bailey staying firmly hawkish. It's actually wild. The UK is maybe the only country right now boasting zero political uncertainty, even though they technically have no incumbent PM. Just watch out for the UK construction PMI and comments from the BOE's man later today. Now, for USD JPY, it is purely a tactical two-way trade right now. Traders are basically daring the Ministry of Finance to step in as Japanese 10-year yields aggressively test those 30-year highs. Markets are already pricing in a 60% chance of a Bank of Japan hike by October. So, tactically speaking, you could buy at 160.57, keep a tight stop at 160.30, and target 161.94. Or play the other side, sell at 161.94 with a stop at 162.35, looking for a move back down to 160.57. Okay, shifting our focus over to Indian markets, we are seeing quiet strength in key technical levels. The Nifty finally managed to hit that elusive 24,344 target on Friday with a gap up. It couldn't quite hold it through the close, settling around 24,270, but this slow, steady strength is very real. It's being heavily supported by aggressive buying under the surface in IT and metals, specifically names like HCL Tech and Hindalco. And look at the India VIX. It cooled down another 4% or so to settle right at 1180. Honestly, it looks like traders have finally remembered how to sleep. Adding to that overall sense of calm, government bond yields are just hovering right near 15-week lows. So, what's the play? The tactical view for both the Nifty and USD INR is a clear buy on dips. For the Nifty, you've got strong support way down at 23,900 and resistance capping things at 24,344 and 24,561. As for USD INR, we're targeting 96.18 on this trade. You've got sturdy support sitting at 95.21 and 94.92, with resistance at 95.43 and 95.82. Just be patient and let the price action come to those levels before stepping in. And there is a massive fundamental driver behind that rupee action. Those recent RBI rules have sparked a flood of FCNR deposits. We're talking nearly $7 billion booked in June alone. In July, the estimates are wildly high, ranging anywhere from $40 to $60 billion. That creates an incredibly supportive backdrop for the rupee, easily sweeping up the dollar demand we're seeing from merchant flows and NDF maturities.
As we wrap up, we're looking at the week ahead, where data takes center stage. Geopolitics are taking a backseat and hard macroeconomic numbers are driving the bus. The global slate is completely packed with potential volatility catalysts. In the US, we're watching the ISM Services PMI, the Fed minutes, and jobless claims. China is giving us its CPI and PPI prints. Over in the UK and Europe, we're getting updates on fiscal stability and production data. And finally, India will be reporting its absolutely crucial balance of payments figures. Seriously, every single one of these data drops is going to be treated by the market like a TV season finale, because right now in these markets, the suspense literally never takes a holiday. So the real question you have to ask yourself, especially looking at today's technical setups, is, are your portfolios positioned for that suspense? Staying anchored to the tactical levels we just mapped out is for sure your best defense out there. Have a fantastic trading day, stay disciplined, and I'll catch you next time.